What's up everyone, Nate here, and I wish I was here with good news, but unfortunately, I'm not. Stocks are tanking again, and actually they've been tanking for quite a long time now. But the biggest drops that we've seen recently is because of two big bank stocks like JP Chase and Goldman Sachs actually releasing pretty disappointing earnings reports. That caused the market to go into a frenzy, and well, you can guess the rest. And on a normal day-to-day basis, stocks go up and down. However, right now what we're seeing on the stock market may be anything from normal. And honestly, there is a lot more going on here than just a few bad earnings reports. So today I want to take a minute to talk about what is going on Wall Street right now. Why is the New York Stock Exchange starting to tank? And what is its future outlook for 2022? But before I get into all of that, I need you to do me a quick favor and smash, hit, or destroy that thumbs up button below. I really appreciate that because it helps me to make even more great content here on YouTube. Thanks for doing that, and now let's talk about stocks. So like I said at the beginning of this video, the stock market has been dropping for a little while now. Ever since January 1st of this year, the stock market has pretty much gone down. And normally that wouldn't be a major deal, but there are a few key indicators that might show that the stock market may continue to go down throughout the rest of 2022. The first key indicator that we need to look at here is the bond yield, or the bond yield curve. Basically, the bond yield will show investors what their annual profit is going to be from that bond investment. And a bond is something that investors can buy that essentially gives someone else a chunk of money. So we have treasury bonds and we have corporate bonds. If you invest in a treasury bond, then you're essentially giving the federal government a chunk of cash, and then they will eventually pay you back for that investment with interest. So think of it like you are loaning your money to the federal government. And yes, this is on top of the taxes that you pay. You can do the exact same thing with corporations here. And a lot of people consider the treasury bonds to be a lot more stable because the United States government really isn't going away anytime soon, at least as far as we can tell. Corporate bonds are a little bit more risky because you don't know if that corporation or company is going to last through the entire period that you bought the bond for. And right now, the 10-year treasury yield is trading at around 2%, which is a near 2-year high. And remember, the yield is what investors will actually get from that investment after the entire period has been resolved. So a yield can actually go up or down depending on the situation. And right now, we're starting to see yields for treasury notes starting to go up in the United States. When you start to see the yield actually go up, that means that there is a lower interest for those yields. So that means that the Treasury Department is going to start paying out less interest for all of those bonds. This means that the bonds are becoming riskier because you're getting a much lower interest rate and a much lower return potentially on your investment overall. So why exactly are investors starting to turn away from these bonds right now? Well, it's simply because they are a risky investment, and some investors don't want to risk a lot of their money, especially with the economy starting to shrink. We saw back in December and the early parts of January that the Federal Reserve is going to be making a lot of monetary policies on our economy, and that has a huge effect on the stock market. Basically, there's going to be a lot less money going around in our economy. And when there's a lot less money circulating throughout the economy, well, investors want to put it in places that they know it's going to be protected. They don't want to put their money into an investment that is not going to give them a good return. Think of it this way. If you had $5 and you had a choice between taking that $5 and putting it into a slot machine to where you could win $100, but the potential is not really super high, or if you could put that money into a guaranteed investment that you're going to make probably $10 to $15, which one are you going to pick? Remember, you only have $5. Most investors are going to pick the safe investment because that's all the money that they have. Now, I should say here that not every investor is going to pick the safe option. Some investors are still going to go that risky route because they want to see that great return come from it. That's just the way that it works. So you're actually starting to see the yield go up, which means that the demand is going down and the United States government is offering a worse return. So that's number one, but number two is all about earnings. Now, I started this video talking about JP Chase and Goldman Sachs. Those two banks had some pretty disappointing earnings reports in mid-January. And what you're probably thinking is, well, I don't really care about if big banks are losing a bunch of money, but big banks losing a bunch of money is a pretty big indicator of our economy and the direction that our stock market could be taking in the future. Have you ever really thought about how banks make money? I mean, banks hold a lot of our money, but we don't really know how they actually get a lot of their money to function. Well, the way that banks make money is through loans. They actually give out loans, and then you pay those loans back through interest. So if a bank has a really bad earnings report, well, what does that mean? They earned less money because they are issuing a lot less loans. And this issue is kind of twofold because you have to ask yourself a series of questions. Why are banks starting to give out less loans? The Federal Reserve has not yet raised its benchmark interest rates. So if interest rates are still pretty low, then what is stopping people from getting all of these loans? Well, there is a few different things happening. First and foremost, everything right now is getting super expensive, and that includes anything that people want to buy with a loan. So housing, and also cars and businesses. All of that is starting to cost people a lot more. And if it's costing a lot more, then people are going to get a little bit scared about taking on a massive loan in order to pay off those things. Interest rates being low since the start of the pandemic has made it really easy for a lot of people to get loans. That means when prices were pretty normal for a house and a car, you could save hundreds of thousands of dollars over the lifetime of the loan. And that works if all of your prices are super low, but if prices start going super high again, then that means it pretty much negates the low interest rates. Eventually, buyers are going to be priced out of those markets, so it's going to be super hard for them to get a house because housing prices have exploded over the last 2 years. Same with auto prices. Used cars are actually more valuable right now than new cars because you can't get a new car. I mean, it's pretty much impossible. Even if you can get all of those things, like you can actually get a mortgage at a certain range and a car, the problem is there's just nothing on the market. Like I said, it's really hard to come by a new car that isn't spoken for. Same for a house. A house that's put on the market in your price range is probably spoken for before it even hits the market. And obviously a lot of these pricing problems that we're having right now is a symptom of the huge inflation that is wrecking our economy. On the recent Consumer Price Index report, it showed that inflation hit a new 40-year high of around 7%. Now, the Federal Reserve is taking steps to try to lower inflation in 2022, and we'll get to those in just a minute. But basically, when you see these big bank stocks like Goldman Sachs and JP Morgan Chase start to drop, and that is a big indication that Americans are starting to spend less money. And that there is a lot less capital, because you have to think about how these banks get a lot of their money in the first place. Banks actually get a ton of their money because you put your money in the bank. What do you think the bank does when you tell them, take this $2,000 and put it into my savings account? Well, they take that $2,000 and they go loan it out to someone else. So they actually get a ton of money just because people are putting money into their bank. That's how they get the capital to then send it out for more loans. But right now, people might be spending a lot of their money and keeping a lot less money in bank accounts. And basically the stock market saw that and got a little scared because there's a lot of other things going on that might signal that the stock market and our economy might start dipping in the next few months. I think most stock market experts would agree that this first quarter of 2022 is going to be pretty huge for earnings in general. We had the holiday season in November, and December really push a lot of shoppers to spend a record amount. In fact, shoppers spent around $204 billion just online during the holiday season. That is a new all-time record. So where are they spending a lot of this money? Well, they're spending it at your traditional retailers like Kohl's and Walmart. So Americans spent a ton of money during the holidays, but that's what the holidays are all about, at least for the majority of Americans. Go out and spend as much money as you possibly can for the people that you love. Except for now you're in debt and can barely afford to buy anything else that you could possibly need. But at least you're doing it in style with those brand new Nikes. So you're probably going to see a lot of explosive earnings reports in Q1 of 2022. All of them are going to be reporting their numbers for 2021 and Q4 2021, and we're going to see a ton of records. Think about it. There were so many sales, so much money throughout our economy. Americans were a little bit wealthier in 2021. There was just so much money going around. But now it's January 2022 and inflation is at an all-time high. I mean, we haven't seen inflation like this since around the 1970s and early 80s. So it's been a long time, and that means Americans are going to be less likely to start purchasing more right now. Americans are going to start being reserved, and you're going to start seeing a lot lower earnings reports throughout the rest of the year. What does a low earnings report signal to investors? Well, that company isn't making any money. And if that company's not making any money, then investors are going to pull their money out. And we could end up seeing this in mass with company after company starting to drop bad earnings reports. And that's just for the earnings side of things. There's a lot of other things that are in these earnings reports. A lot of the information covers the costs that the companies are going to have to start covering in 2022. And costs are going up for companies too, because one, they're going to have to start paying their employees a lot more. Wages are going to have to start going up, and they have already started going up in the United States. That comes at a cost to employers. Number two, shipping and delivery costs are going up because companies have to start producing more in order to end our supply chain crisis. And they're going to produce so much, they may even start producing way more than we could possibly need. All of that is going to come at a cost. And if you couple that with Americans not really buying as much as they used to, and that could mean that earnings reports are even worse than expected. That is bad news bears, and the stock market is just now starting to get a taste of what that could look like, and it does not like it. In fact, the S&P 500 dropped 500 points when it saw that Goldman Sachs put out a bad earnings report, and that's just one company. We have a ton of others to go through, and like I said, Q1 is probably going to look really good to investors, but as the quarters progress, we're going to see less and less money in our economy. Now, let's talk all about the Federal Reserve. Now, the Federal Reserve plays a huge role in what is going to happen on Wall Street and what is going to happen with your wallet too. The Federal Reserve is basically in charge of our monetary policies in the United States so that it can curb inflation. They decide how much money is actually going to be printed, and if they start to print way too much, then you can start to see inflation go way up. If they print way too little, then that can actually make our economy shrink because there's just not enough money for people to really use. So there's a delicate balance here, but they have printed a ton of money over the last 2 years. We're talking into the multi-trillions. And recently, they kind of realized that they messed up because they've come out now and said that they're going to do whatever it takes to lower inflation in our economy. But doing whatever it takes right now with all of these other factors going on could send the country into a recession. The reason being is because A, you have inflation at an all-time high, so Americans aren't going to be able to spend as much as they could before. Prices are going way up, and wages aren't meeting that inflationary level, so people just don't have the money to spend. And then number two, the Federal Reserve has also talked about raising its benchmark interest rates a few times in 2022, so that's going to make it a lot harder for people to get loans, and guess what? It is already hard enough to get loans with prices being out of control right now. So that means even more Americans are going to spend less money. That in itself is going to shrink our economy. And in case you didn't know, shrinking bad. The only way that our economy starts to grow is if we have a ton of money in it. But like I said, you need a balance of that money. You can't have way too much and you can't have way too little. But the Federal Reserve is going to get aggressive with inflation. Their goal is to drop inflation down. But ultimately, that's going to hurt the stock market. Investors, the stock market, it's all about your ROI. What are you going to get out of this investment? What is your return going to be? If it doesn't look like you're going to get a really good return on an investment, then why are you investing your hard-earned cash into that stock? Companies are going to take a massive hit because of lower interest rates. I mean, we've already started to see that happen with banks. If banks are losing money on their loans, then what that basically means is there is a lower demand for their loans. The only way that they can make money is by raising their interest rates. So you have banks raising their interest rates, and then you have the Federal Reserve raising its interest rates. Now it's going to become incredibly difficult for people to get a loan. If nobody can get a loan, then nobody can get a house, because I don't know about you, but I don't know a lot of people that have hundreds of thousands of dollars just lying around in order to buy a house. I mean, most people get a mortgage. So you could see the housing market begin to tank, and then the auto market begin to tank. Then individual stocks and ETFs start to tank too, because now nobody is making money. And you got to remember too, in 2020 and 2021, these companies had record profits. Because there was so much money going around, people were spending it. And like I said, they were spending it at your big box retailers. Now though, it looks like a lot of those profits are going to start going down. So the question really is though, are those profits going to hit what is considered normal levels, or are they going to dip below that? If we start seeing profits go down for every company and banks, then the stock market could see a massive crash. And of course, this all assumes that our pandemic is not going to get worse and that our supply chain issues and our great resignation problem is eventually going to get better. But there is no guarantee that either one of those things is going to happen in 2022. I think a lot of people right now are going to continue to be out of a job because, yeah, working at a job that you hate for money that can't even support you is not what a lot of people want to do right now. And that could honestly make a problem worse because now fewer people have even less money. And if we see this for 2 quarters or more, then we could be in a complete recession. Now, the bigger question here is this actually all going to happen? And I don't know if all of this is going to happen. I mean, I think that some of this is going to happen. There's kind of a gray area between what is really going to go on, but it really just depends on what goes down with the Federal Reserve and the stock market. Looking at the bond yield right now, it looks like investors are starting to take a lot less risky investments on. They're going to start going back to those value stocks. They're going to start going back to those blue chip stocks that are going to give them a solid return no matter what goes down in our economy. We've even started to see other riskier assets like Bitcoin start to go down because investors, especially the institutional and traditional investors, are pulling their money because they're not sure how those assets are going to fare if a lot less money is circulating in our economy. And it looks like there's going to be a lot less money circulating in our economy in 2022. That is the only solution the Federal Reserve has when lowering inflation. They can't do much about our supply chain issues, but they can lower demand. And if demand is through the floor, then prices and our inflation will start to go back down. Businesses not making any money is bad for everyone because then they can't pay their employees, and then their employees can't make any money, so they can't go out and buy anything either. So that is a big issue for our economy. So if we start to see profits go down too, you'll see the stock market start to pull their money out. So like I said, when you start seeing investors go from those risky investments to some not risky investments, that basically shows that you could have some economic turmoil in the future. Investors don't want to lose money. I mean, nobody wants to lose money, so they're going to bet on things that are going to give them a return because they only have so much money to give. when there's a lot of money going around, investors can just throw it at risky investments because they're not afraid to lose it. Now, investors are afraid to lose money, and you're seeing that with the stock market tank all throughout January, and earnings reports start to get shot down too. But with all of that being said, I want to hear your thoughts on this issue. What do you think is going to go on with the stock market in 2022? Do you think that the perfect storm is brewing right now for a stock market crash, or do you think that the stock market is going to be A-okay in 2022? As always, be sure to join the conversation below and leave a comment before you go. But that is it for today's business and financial news breakdown. I hope you liked this video, and if you did, smash that subscribe button below, because we are putting up videos every single day exactly like this one on all of the top business and financial news throughout the country. So you definitely don't want to miss any of it. But that is it for me. Be kind out there, and I'll see you all in the next one.